Hello, everyone. Welcome to today's session. Let's jump right into it here. Let's start out with some market conditions, and we'll go through kind of our top-down approach. That's really what the overall system is designed to do as a top-down approach. What we do is we look at what's the big picture, what's the long-term trend that the stock market is in. And in this case, we're focusing on the stock market as the S&P 500. There are various ways to, a composite index or something large. In this case, the S&P 500, in my opinion, is enough stocks to be able to determine the market direction. So we start out with, when we're starting out with market trends, we go direction alerts tab here. And then what we're looking at on this chart is we're looking at a 20-year time frame. This chart goes 20 years, and it's got each of the major signal shifts that are happening here. And along this, we've had this real massive uptrend since 2008, and each of the little downturns that we've had immediately turn back to the upside. So in this case, and that's as momentum traders and following the trend, that's what we're looking to do. We're okay if the trend is shifting and we need to make a decision and jump back in versus being stuck and married to a direction and saying, no, I'm right and the market's wrong and I'm going to hold to my guns. That's a bad approach, because the market is always right, and so we just need to follow what that overall trend is doing. So in this case, we're currently in an overall uptrend, but we also know that we're extended to the upper range of that uptrend, and we've kind of been flattening around that 14 number. It's tops out at 5 because traditionally that's about where the market does top out. The last 3 or 4 years, though, we're seeing those numbers bounce all the way up, and you can see that number right here. The rank of the bull market is 14.97. That's equating to this number here. So we're definitely extended to the upside, and now we're contracting that, consolidating that uptrend, and at least as of now, we'll look at the overall market conditions. At least as of now, that's the overall bias, is an uptrend, but we're correcting and we're in a down or bearish state in that uptrend. So when you see this little paragraph right here, it says bearish in a bull market. The bull market part of it is this long-term trend. The bearish part of it is this retracement that we're dealing with right now. We'll talk about that. Two of the things that we have now is momentum and breadth, which are oversold. So let's talk about that for a minute. When a trend becomes extreme one direction or the other, then it's just gone too far too fast. And what happens in those locations is, on the top end of an extreme, you run out of buyers. There's nobody left to buy. On a downside extreme, you start to run out of sellers. Everybody that has sold has done so. And typically that'll happen in a 2-part counter trend, like this, like this, like this. So we're getting to an area where we could start to see some indications of a bounce, whether that's an entire continuation of the uptrend, or if it's just a short-term bounce. That's obviously, you never quite know if that's going to unfold, but you would start out with the overall bias. What market conditions am I in? In this case, I'm in a bull market. I'm in an uptrend, but we're retracing or pulling back that uptrend. So that requires some caution in the short term, obviously, but if we start to see some bounce and start to see some buying interest come back into the market, now is the perfect time for that to start to happen. We're seeing momentum extreme, we're seeing breadth extreme, and we're seeing sentiment not extreme. Sentiment is still relatively complacent. So those 3 setups in looking for kind of the shorter term market conditions, that's really what this page is designed to do. From there, we can then also add some of these additional indicators to say, where, yes, we're at a short-term correction, and it's indicated by this red above the green. Okay, if we were in an uptrend with the majority of stocks, what this is, it's the buy-sell ratio of the stocks in the database. So of the stocks that we track, then and it's only tracking index exchange stocks. So it could be 5,000 or 6,000 stocks, even though there are more stocks in the database. We're only tracking these for the major indices so that it's big, it's big stable companies. We're not going to track all the OTC and penny stocks and a whole bunch of things there. It's not worthwhile. So in this case, you've got a lot of stocks in this uptrend or in the downtrend, but we're extreme. Extended here, just like we were extended here, just like we were extended here, just like we were extended here and here. Notice one thing, that doesn't last. It just is not sustainable. So we're now at this, we've had a couple of different moves. This is the two-part counter trend of that SPY, S&P 500 pattern. And now we're starting to see, again, just some width. That doesn't mean that we can't get, if the market really gets spooked by maybe some other data point or some earnings that are going to be coming up here over the next month or so, we could see acceleration to the downside. We talked also, is indicated by this number down here. The bottom, you'll see 0.15. Okay, that 0.15 is saying that there's just a lot more stocks that have sell signals than have buy signals. Or when it's all the way up to this other side, you're getting buy-sell ratios of really high numbers like 10. Even right here, it was 4. That means it's a 4-to-1 buy-sell ratio. So there's 4 stocks that are in buy signals versus 1 stock in sell signals. That's the ratio. So when we're down here negative like this, 0.15, there are just a lot more sells than buys. We can mouse over that and say, okay, 3,200 sells, 500 buys. I can also go over here to this, to the sectors, and it's going to line pretty close, not quite exactly, but you can see buy-sell ratio 0.19. But now we can also look at the sectors and say, what is that buy-sell ratio telling me on the overall sectors? Now, this is a little bit more visual to see here. You've got 82 sells and 12 buys. It's not tracking the stocks that are stuck in the middle, stuck in that hold range. And so in this case, everything is to the downside. Once that starts to happen, that obviously that could shift the momentum to aggressively bearish, but it also could be if the panic or the sell-off is really unwarranted, or if it's just a counter trend correction, then it could start to ignite some buying interest in names that bigger institutions are interested in buying. Same with the indexes tab, it's going to show the ratio here. So we're less than 0.2 on almost everything, and so we definitely know that we have a bearish bias. Another indicator that I like to use is the sectors ETF, and then just sort it and say, okay, you can look at the sectors: consumer service, healthcare, industrials, real estate. Everything is in a downtrend. The only things that are not in downtrends, and they're not even that fantastic: energy, utilities, financial. So really weak market conditions right now, and nothing to, no reason to get real excited about the buying opportunity when and if that ends up happening right here, because everything is sliding at these levels. Now on the 6-month time frame on SPY, that momentum now you can see is getting extended to the downside, negative 200. And we're at a 50% retracement now of this swing low and this swing high. If we go out to the 1-year time frame, the real big next stop is looking like about 416 on SPY, this ratio right here. So if we take this time frame from here, the snap tool is automatically connecting to that. So it's drawn out. If you don't know where that is, it's this button right here, and you can go in and you can edit the numbers that I've got just by this box. So the 236, 382, 50, 618, those are the main ones that I like to use. 236 is the momentum zone. We've sliced through that now on S&P 500, and now we're in that counter trend corrective zone. So we could take this entire move, and really anything back to 50% could just be corrective. It could be counter trend here to this trending direction, and we could still find some support and go higher. But it's looking like that next stop is, and there's a pretty big void between this level and where we just came from in terms of any support or resistance along the way. The only price activity we have here in the last year is that area. We could go back another year and see if we get any of that 2022 or 2022 price activity. Now notice what it did though. The 2-year trend is actually down. So it's actually on the 2-year price trends, it's flipping the direction. And we're back up above the 618. So it's pretty healthy bull market. But in terms of that price activity now, if we look to see if there's any price areas along here, there's a little bit over here and a little bit over here that might create some support, but really not a lot until back down in these areas and right here and right here. So 414 on S&P 500, we could continue to see some sliding. That may not happen in one fell swoop. That may not happen in one trend. That may happen over the course of, a bounce and a rally back up and test this level and then back down again and then test it and then back down again. We could see some ups and downs along the way, but we're definitely starting to the market is making things harder and harder for more upside. And that needs to be the stance right here is bearish in a bull market. And that means really what that means. And that's part of the reason why we include that in here is it says this means that traders and investors consider trading with a bearish bias by raising stop levels on winners and selling losers. So what the market conditions allow you to do for portfolio management is more about position size and exiting losers and raising and managing your risk essentially. So raising stop levels on your winners. Okay, in terms of money management, what we prefer is sell your losers, the ones that are not working, the ones that are already down or losing and they're continuing that direction. That is not working. So why hold on to it and hope that it continues to work or hope that it might work? If it's not working, get rid of it. Okay, so that obviously needs to be set up in advance to sell the losers. Raising stop levels on winners so that if you do, because sometimes if markets really start to collapse or move lower, everything starts to drop, even good quality companies. And it just allows you to potentially get back in a little bit later, but having your stop loss in place so that even if you've got a winner, you're not giving away some of those gains. Okay, so a couple of ideas there for you in terms of utilizing these tabs. The sentiment also the sentiment and buy sell ratio work well together when I can say on the market as a whole, when we're really wide like this, and if I look at the sentiment indicator with that and say, okay, I'm wide to the bearish side, right? So we know that this is extreme now to the downside, and historically, at least in the last year, these levels anywhere near this green line has created a bounce. We've got a bounce at these locations. Now, if I were to go back a few years, you could see that it can get a lot worse than this. Not a lot worse, but it can get worse in terms of the level. So here's our uptrend that we've had this last year, but some of the selling at the bottom down here was significantly lower than where we're at now. So if we are going to roll over and really get aggressive to the downside, there is a little bit more room for that to happen. So what we want to see now is we want to start to see the markets start to show us some strength, show us some indication that it's going to hold. And today doesn't look like it's going to, at least as of right now. That's a pretty aggressive down bar, down 1.5%. Not nasty, not a big 3% day or 400 or 500 points on the Dow to trigger any kind of panic. It's still relatively orderly, but it is to the downside nonetheless. And we might as well just wait for some confirmation, wait for a day or two, a bar that gives us, in this case, a green or a white bar to the upside. Yesterday we had an update close and then just continually giving that back today. That's kind of our market conditions currently. Is everything is weak. It's an opportunity to continue to build out watch lists and continue to look for ideas. And if you want to, there's always selective trades in the new buy list that that are continually going to work no matter what the market's doing. So if you want to continue to look for opportunities, even in this down market, then the new buy list is still going to be looking in, and it typically is going to be moving into sectors that are working, like oil. Like oil stocks are moving. This is one, OII, which has had a nice uptrend. Let me switch it back here. Oops, back to signals. And we've had this uptrend, this bounce off of the 236, which is the momentum location. I talk about this momentum location when we're up in this range here and the stock price has moved this direction. This is where we want to play with it, is inside of this range, ideally, because it'll continue. If it moves higher and then it retraces back down to the support, it'll typically find some support around here and then continue the uptrend. Rally, pull back, still inside that range. It moves. It's a moving target. For example, if I were to just take this and go something like this, you can see, okay, if we were back here on this day, this green day, which was, about a month ago, August 30th, our bar would be set here. So we could be analyzing this and saying, okay, it's got a new uptrend. It's in the buy zone. Should I buy that stock? Yes, I could buy it based on that information alone. I could set a stop loss right here, or I could use maybe a trailing stop below this 382, because watch what's going to happen to that number each day. We go one more day out, it moves up a little bit. Okay, now it had another big move. Now it's connecting to the highest point and the lowest point on the time frame on the chart right here on this 6-month chart. But also notice that this 382, once this moved higher, it's going to pull this number up as well, and this one as well. So as it's moving higher and it's connecting to those new highs, it's going to move this number higher. So you can use this as a trailing stop if you want to as well. And again, trailing just means that you're trailing each day that comes along, and as it's moving higher, if it keeps moving higher, I'm now adjusting my stop. Notice that this 382 started out down here, and it's just gradually been moving higher the last 4 or 5 days. That allows you to have a stop adjustment mechanism if you prefer to do that. I typically will still use a stop no matter what, just even if I'm maybe waiting for a sell signal, just because I don't, right now when markets are a little bit sketchy, I don't want to have anything move outside of that buy zone. And I may just stop out of it if it does and continue to hold anything that's moving in that uptrend. So let's continue on and see if we retrace. So we retrace. Now it's retracing. Now it's connected to this upper level. This becomes the high water mark. Now as it's starting to move back again, now I'm talking about what we just talked about. Should I sell it if it breaks this line, starting to show some weakness? Let's see what ends up happening. We get a day of support, another day, and now we're back up again. So ultimately, this upward trend, it connected here and it's still maintaining it even with the retracement. And then these lines start to become our risk parameters to say, I'm not, we went from here and all the way back down again. I'm not willing to ride that out. I'm going to exit the trade at some kind of a trailing location. It's a pretty easy mechanism to be able to do that and be able to make that kind of adjustment. So you're getting a couple of uptrends on those first two stocks. I'm just going through that new buy list right here. Let me actually refresh. And CAMT, OII, PAY, also a nice looking pattern here. And not surprising, this is what the market can do on a day like this. If the market is moving higher and you're getting good stocks that are moving up, they may be a little bit more muted or not continue the breakout or just have some selling that's happening in there on a down day. So even strong stocks in an upward trend, granted that's not that big of a deal. That's just natural volatility right there. But you're going to get some stocks that do that. Here was another new buy from yesterday. This one's up 4% and breaking out. Industrial services. Again, from here, if you want to just take and say, well, what do they do? And maybe I want a little bit more information, you can go to this drop down, go out to some of these other sites as well, and do a little bit more homework if you prefer to be able to do that also, which I we'll do from time to time also. COUR, XPRO, there's always good looking stocks. In fact, this is oil production, and they've got a lot of green in the earnings. You're seeing some of the oil stocks that just are not, they're not making any money or they're not moving. So if you're building out some stocks and you're looking for new entries, then the new buy list is a good place to look. Just because the continuation of that, there's going to be times where you get a new buy. For example, this day right here, you get a new buy, and immediately next 2 or 3 days it starts to reverse. That can certainly happen on any stock strategy, but you've got a mechanism for the entry and you've got a mechanism for the exit, whether it's holding it and waiting for a sell signal, or right now where market conditions are a little bit unfavorable, I would always make sure that you have that initial capital investment at a certain amount of fixed loss, so that okay, I've entered a trade today. It's the first trade. It's new money. It's my first $1,000 that I've put into this stock. I want to make sure that I know what the risk is on that trade. And an easy way to do that is you can click on one of these, add to portfolio. Whether or not you add it to a portfolio that you have saved or not, you can at least run some numbers and say, okay, if I have a $100,000 trading account and this stock is at $24, and I decide I want 100 shares of that, and I'm going to place a stop loss at say $22. 22 is going to be right, maybe down right around here. I could set it a little higher, but let's just set it at 22 for a nice round number. Now, what this tells me is I have 8% of my trade at risk. That's where my stop loss, $22 stop price, sets my trade risk at 8%. But my portfolio risk is 0.2. It's only $200 of my 100,000. So I could say, oh, I'm willing to take a little bit more risk. But in order to do that, I've got to control my position size and I've got to control my stop losses. These are the only two things that we have control over: the number of shares we're buying and the stop loss. We can't control what the market price does. We can control when we get into it. Okay, so but if we're doing it based on a location or a new green bar for the day, then we're following a methodology, but we don't have any control of what the price is going to do, obviously, after that fact or at any time. We just have to decide when we're going to get in and then how we're going to manage the risk going forward. So this is one of the ways to do that. And then you simply know, okay, if I get stopped out of this trade, or if it trades anything lower than this line, that 38236 line, and I haven't been stopped out yet, I could manually go in and say, I'm out. I don't want to. It's not moving in the direction soon enough. You can add that into your trading plan as far as having a manual method for exiting a position as well. A pretty easy way to be able to do that. Okay, and then from there, it's just simply keeping the risk in a reasonable range, so that you're not overly exposed. You're diversified. You could have. We've talked about this in the class before, that there's different arguments on what's an ideal number of stocks to hold in a portfolio. I've mentioned Buffett before. Typically, he doesn't go any more than 50 holdings max, or less. I think, and some would argue 10 holdings max. Some would argue 5. Some would argue 20. A lot of that's going to depend on the amount of volatility and diversification that you are willing to have on an individual stock. In these market conditions, I would keep that relatively small and just have a few more holdings. It allows you to diversify across multiple stocks versus multiple asset classes, which you could also do. So you can also allocate towards different ideas and say, okay, I'm going to have 50% of my holdings in equities, and I'm going to have 25% of my holdings in an ETF of some kind. And you could come out here and say what ETFs are moving. There's lots of different things. There's lots of different ways to play these ETFs, because they have leverage ETFs, they have inverse ETFs, And for example, just this one right here, this 20-year Treasury bear 3x, negative 3x direction. What that means is it's going to move negative 3%. It's going to go up by 3% when TLT or bonds goes down by 1%. So if I were to go TLT, you can see it's dropping off the table right here. Okay, but that ETF is going to allow you to profit on the upside by 3 times the amount that it's dropping. So you can see as TLT was dropping, this is going up in value. So now, just like TLT was extreme to the downside, TMV is extreme to the upside. This is not sustainable at this point. We probably will see at least a short-term move in bonds. I sure hope so, because I think the market is waiting for that right now. TLT, the market really wants, because what's happening, okay, as bonds are dropping, interest rates are rising. That's another ETF that's actually in this muscle ETF group, is right here, this PFIX. This is interest rates. So if you're looking to buy interest rates long, this is one of the ways to do it. But again, it's a little extreme right now. It's just unsustainable. Stock markets are moving and they're extreme to the downside. Bond markets are also down, but interest rates are up to this extreme range. So both are almost exactly negatively correlated, and so we want to see interest rates drop or TLT or bonds rally in order. I don't think unless that happens, SPY is going to do anything. So I think if we continue to see bonds slide, we're going to see equities continue to slide. But this bond slide has been historic. I also talked recently in one of my classes about stagflation in the 1970s. I was born in 73, so I just turned 50 this year, but I remember as a kid, the late 70s, I remember my parents talking about interest rates, and it was 11, 12, 13, 14, 15%, up to 18%, I believe. That we're not, we're griping about 4.5%, 5% interest rate. Think of the world if we have to move to 15, 16, even 10% interest rates. Good grief. But that's not out of the question right here. And the bond market is still TLT. Let's go to 1 year, is still saying that interest rates could go higher. They could go significantly higher. But we're deeply oversold. We could rally back up, but this trend is such a nasty downtrend. That's kind of the doomsday or scenario, but I think it's important to be aware of those situations. I've mentioned this bond yield curve before because the bond yield curve, I've been doing this about since this chart started, not quite, but 1998. I graduated from the University of Utah in 1998 and started trading actually about that time. The dot-com run. It's funny because I actually was sitting in a class, it was a marketing class in 1997 or 6, and they were talking about this new thing, the internet, and this new company called Amazon, selling books out of online. And if I had 2 dimes to rub together as a college student to put into Amazon as we were making those discussions, anyway, it's kind of fun sometimes to look back. But my point is, watch this line right here. This is an inverted yield curve. Short-term interest rates are higher than long-term interest rates. To tie your money up for 3 months, you're going to get paid more than you would to tie it up for 30 years. That's an unhealthy economic scenario, and it's designed to slow the money flow. It's designed to force borrowers not to borrow and not to spend, because the more money that's in circulation, which is what the Federal Reserve does, is just create more or less money in circulation. If there's more money than there are goods, then that money is going to chase those goods, the fewer and fewer goods, and it's going to drive the prices higher. That's inflation. Fewer goods, more money chasing those goods, that's price inflation. Okay, well, the Fed raises interest rates to slow that down. Now, if we look at the bottom, here's a healthy yield curve. This was 2002, the market bottom. 2007, market top right here. Look at interest rates. The market crash in 2000. That's a healthy yield curve. Fast forward up here to COVID. Okay, COVID, we had the COVID move, interest rates. The yield curve is healthily, moving higher, but watch this line as I move up, 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 up. Okay, even right here, interest rates were next to nothing. They were basically zero. They're giving money away, tons and tons of money going out into the system. Well, what is stocks going to do? Stocks love that because companies can borrow a ton more money and grow at next to nothing. Okay, so they grow, grow, grow. Well, that creates an inflationary situation that we're in now. Markets start to contract, but look at interest rates now, rising, rising. But this is where we are today. Okay, this is today and this is today. Does that look anything like this? Does that look anything like that or anything like that? No, it looks like this. It looks like the market top here, and it looks like the market top here. So this still should be concerning for equity holders because that has to still unwind. Okay, that the bond market has to be in agreement with inflation, and the Fed ultimately, who's in charge of that? It's always hard to say. Whether the bond market controls the Fed or the Fed controls the bond market is up for debate. But this is a risk. This is an overhead risk that we need to be aware of. That this is not the interest rates and inflation. That game, that's not over. That is still the number one talking point and the number one thing to be aware of right here. So if we're seeing the market start to price that in and start to move to the downside, we certainly are seeing it if we go back to market ETFs and look at, or actually go to sector ETFs here, and we look at the real estate one, which was this last one right here. Okay, the real estate sector is really just been getting hammered. This is still the 1 year, but you can see as those bonds, as the interest rates spiked, this is what the real estate ETF is doing. So real estate mortgages, it's just, it really could get nasty if the market finally realizes, or if it becomes a reality that, man, things are not getting any better, and they're probably not, and we're getting ready to go into a recession. That then real estate is leading that game because of the interest rate. It's going to be the most interest rate sensitive market, and we're definitely seeing that right here. And again, you look at real estate. Well, what would be the exact opposite of that? It's going to be this chart right here we just looked at, interest rates. So as rates are rallying higher, more real estate is tanking. So that both are extreme. It's an unsustainable location that we're at now, but it's definitely a trend. Okay, this interest rates are definitely in the momentum range right here, and we'll have a lot of work to do moving forward. Okay, so where are the areas of support? It is, or the ideas moving forward, it's going to be in potentially leveraging or using some ideas around inverse or ETFs. Interesting too, notice these two. We've got oil refiners, we've got uranium. There's 2 uranium ETFs right here, and they're moving higher. For whatever reason, I don't know, I just thought of that, but that's an interesting play also in uranium. So commodities, basic material, maybe gold, maybe oil. Okay, those are going to be some of the areas that you're going to see money starting to move into that. It already is moving into that based on whatever the market is foreseeing. Okay, and that's always the hard part. We never know exactly what the market is going to foresee, but we can see what's moving in the market, and then say, the market believes that, or even oil right here. So here's oil, USO, the oil ETF. You can see oil from 64 to 80 with USO, and still in a solid uptrend and moving back into this buy range today. oil stocks, that makes sense why you're seeing some of these oil stocks moving higher, like OII, good solid move. Okay, so in looking for trends and looking for ideas, that's a really quick way that we can glance through and say what's working, what's not working, how do I want to try and profit if I do. Obviously, we do want to profit in any way that we can, but sometimes sitting on our hands, if we're a little uncertain, maybe just as good as sitting out a market correction, okay, or a really volatile market. But there are things that are still working. So stick with the things that are working, watching for some of these leaders, and as they start to break down, making sure that you've got some money management in place. TNGX, this thing has been cruising. Keep an eye on this one. Medical biotech, it had a pullback back to 7. Some of these muscle stocks, when they pull back and they go from hold to green to hold, green to buy to hold, and then they continue to move higher. That's one of the things I'd mentioned in some of the previous classes, is to be watching for still watching for this, but you can add your own custom scan to have all maybe all stocks that are above a certain, I think I've got this from 98 to 100. So this has all the stocks that are 98 to 100. Some of them are buyouts or some splits that haven't been updated, but they also have, like this, they're high ranked, but they've got a hold, or they're high ranked, or they've got a sell. Okay, like this SM&C. This has been a stock that had a real big uptrend. Now it's retracing. That can be an area to be like, when I go in, I'm going to watch for stocks that have a 99 rank, that have retraced, moved lower, but then they're starting a new uptrend. That one hasn't quite yet. But that's another way to look for high-ranking stocks that are pulling back, and create a watch list and build out a little bit of a watch list to say, I'm going to add, LMB. This has been a big runner this year, and I maybe can add that to my watch list and say, well, which watch? I'm going to add this to this watch list. I'm going to save it. I'm going to go to the watch list. Right here, I'm going to add this alert and say, when it changes from a sell to a hold, or when it changes from, to a buy, whatever that is, let's leave it at that, and it's a hold. Now I'm going to get an email at night. When that nightly email comes out, this will be included, because it's like, I don't want to have to go through and remember everything I've set up. Be like, oh, okay, yeah, I knew it was a high-ranking stock. It was in a downtrend. I want to wait for it to find some support and start to move back up again. Now I can get that alert in my watch list. Pretty easy process for managing some ideas that you may want to jump back into. In the meantime, that would have been exited. That would have been stopped out. You can move into a different stock on the buy list. And there's always something moving. That's the fascinating thing, is there's always stocks that are moving and moving in uptrend. So in my opinion, there's not a lot of need for shorting stocks or being aggressively bearish. Stocks are designed long-term to go up forever. Okay, that's theoretically. Theoretically, companies are designed to grow forever. We know that doesn't happen, but the stock price is designed to grow and grow and grow, and then at some point it's going to slow down. The company is going to go out of favor. The company is going to be saturated. It's going to die, or it's going to get, it's going to be bought out, or whatever the case may be. And that's just the nature of the stock market, where you're getting new players. Old players have to innovate and stay on top of the game, or they go under. And so this idea and this entire model is built around looking for the stocks that are working. Some of them are going to be the old bellwethers like FedEx. Some are going to be some new ideas or companies that we had never heard of. They're going to gravitate to the top. Once they are towards the top and they've proven that they're working in that direction, then we can start to participate in that. OLMA, this has been a big one all year long. From 3, really only had this one move back down and continually moving higher. So I'm going to end on that note. Just a couple ideas for you in terms of the process. I wanted to kind of go through that market process. I'm looking for, what's the market doing? At least the S&P 500, the stock market as a whole, is in a retracement. Okay, we know that it's in an uptrend. We know that it's retracing that uptrend, and now it's maybe extreme. It's gone too far to the downside. How might I be able to profit from that? Well, I could look for a bounce here. Maybe I go and I buy SPY at these levels or after a day of upside, or I can go in and I can utilize a leading ETF that's moving, or I can go in and utilize a leading muscle stock, or picking the new buy list, the top 2 or 3 from the new buy list for that day, and adding into my portfolio. And as they're growing, continue to hold on to it as long as it's a winner. If it moves to a sell signal, I sell it. If it stops me out, I sell it. But I keep adding in to the new buy list and building out a portfolio of stocks. And eventually you're going to get a handful of stocks that are just continually working. And you end up with something like this, where you get this one stock and it ends up going up 150%, during the year, and you picked it up back here and it never moved lower. While others that you're buying out of the new buy list can and will, you just drop them out, sell the losers, sell them quickly, and let the winners work. Let the winners continue to run. You've heard that phrase is cut your losers quickly and let your winners run. That's really what this entire model is built or is designed to do, is to keep you in these trades and to keep you in these winners as long as they're going to be winners. At some point they'll stop working, but who knows, right? We never do know. And I've been surprised, some of the crazy ones. Back in 2020, it was Overstock.com. It went from like $5 to $140 in all within one uptrend. It never had a sell signal during that entire uptrend. And and those stocks are going to continually show up here in either the new buys as high ranking or as muscle stocks as well. I'm going to end on that note. I appreciate everyone's time and effort today. Thanks so much, and have a fantastic day. We'll see you next time. Bye now.